Why does this current downturn feel so much worse than the pandemic downturn?
Yeah. It's a difference in pain, right? I mean, the pandemic downturn was more like that sharp, short pain, right? That you get. I mean, it happens all the time. You do different things, hurts a lot, but it's very short and you kind of forget about it quickly. Versus kind of like a chronic pain, right? And those are really bad. I mean, you hear, I don't have that luckily, but I mean, I had a bad back for 3 weeks once. It was really awful. And so that's the difference. We had essentially peaked out on about the 20th of February 2020, and we bottomed out on the 23rd of March 2020. So basically a month. We dropped 35%. That's the fastest 35% drop in history. And it was unbelievable, because basically we were shutting down everything. It was looking like the next Great Depression that could happen. It was really scary. And the Federal Reserve, the Treasury, and Congress just started pumping money out. And altogether, I think it was about $10 trillion came out to support the economy that was basically closed. And the recovery was quite quick. I don't remember the exact month that we got back to the high again and started establishing new highs, but it wasn't very long, three to 6 months, someplace in there. And if you look at what's happening now, right, it's been 5 months of just, and then we get a big bounce at the end of March. It looks good. And then China locks down and the Federal Reserve keeps hammering. And then, okay, we get it. And we're in the middle of another bounce right now. And after a while, you're like, oh, my goodness, is this really going to turn into something or not? And so it's an issue of time and kind of, and this, unfortunately, this is a lot more like what happened in 2008, which was this started in October of 2007 and ended in March of 2009, right? So almost a year and a half. We had several nice recoveries. Oh, looks like we're getting up. And then, and we kept coming down. And again, that was a recessionary environment. Matter of fact, that was a financial crisis, which usually creates the biggest downturns. And that was the second biggest downturn, in the history, going back to 1900 anyway. So, that's why this feels more painful. It's only down 17%. It's down less than that now because it's recovered a bunch. But from kind of high to low, it got down almost 20 if you look at the very highest intraday to the very lowest intraday last Friday. And that's painful, but it's more the time that it's taken. It's more like chronic pain than sharp, short pain. So yeah, it's something to be anxious about. But that's the key. You got to hang in there.
Yeah, because when you think about it, if you start to expand your kind of time frame outside this 5 months, and we start going back to pre-pandemic to now, that's a really good run. And if you told someone, pre-pandemic they'd be at this point in the market, I think they'd be very happy.
Yeah.
The only reason we're kind of anchored to that high is why we're kind of anxious about this lower.
Yeah, that's something to think about not doing as a person. Picking the highest point you ever had in your accounts and bemoaning where you are, you're just torturing yourself. You're exactly right. Take a 3-year look and say, okay, over the last 36 months, what have I made? How do I feel about that? How have I performed versus the market, say, in that 3-year period? And it just puts it into more perspective. And you're exactly right. If you went back in a time machine to 3 years ago and you told this person you were going to make X on your accounts over the next 3 years, they would have been very happy with that. Not knowing that, oh, hey, we had a 35% drop in the stock market, in the pandemic, and now we're having this slow grinding, almost 20% stock market downturn. If you just told them those two, they'd be like, wow, that sounds awful. But they still end up with a reasonable rate of return over that 3-year period, right? You're right. It's one of those things that just has to be put in perspective. Don't lock into the highest value. You will actually, if you have a good quality portfolio, most likely get back to those highest values, but it could take a while. I remember when the Nasdaq hit 5,000 and then it got crushed in 2000 and 2099, 2000, and people thought it would never get back there. Now what is it, 15,000? I mean, it did. It took a while. It took 5 years or something for it to finally get back. But if you're really thinking only about that high point, you're just adding to your chronic pain. and it's a lot easier to look at the long term. And then we talked about this on the last show. It's even easier to really look at the Monte Carlo simulation inside your financial plan and see, what is your probability of success for your retirement at these levels? Are they still pretty good or not? Mm-hmm. And a lot of times they're not that bad, because again, it's looking at the rest of your life. And that's the best way to look at it. So look 3 years back, and then look at Monte Carlo simulation for what it says for the rest of your life. I bet you your pain drops quite a bit, right?
Yeah.
And I think that's a big component of being a good investor, is finding ways to drive your pain down, because if your pain gets too high, you'll probably sell out at the bottom, or close enough to it, and you'll end up with a return that you really, really don't like. So anyway, that's a good question.